Why does this matter? Most buyers, they don't lose money on bad deals. They lose time and money on deals that they should have walked away from. So in any small business acquisition, there are financial red flags, um, especially in these small business acquisitions. Um, a lot of folks are attracted to these businesses, but there's always a little bit of hair on them, as what we always say. It looks like there's a mixed audience. So there's one individual who's under LOI. Half the group is actively searching, and there's a few folks who are just starting out with the search. So it's a great group. There's a lot of particulars around this webinar, which is applicable to all of you. I will say if you are actively searching or if you're under LOI, pay close attention to some of these financial red flags because as you are digesting these financials of the prospective companies, and if you're under LOI, you want to be on the lookout for certain things. To the individual who is under LOI, I'd love to learn more about your deal. If you have questions around it, feel free to put those in the chat and maybe we can talk about them live if you're willing to share. Um, so why does this matter? You know, 30% of acquisitions, this is based on a survey, face post-close surprises. So what does that mean? It could be a surprise of a new thing about the business you've learned after you've closed on the business. It could be something about the operations of the company. It could be a skeleton in the closet that you weren't aware of. Um, Post-close surprises could be significant, which may have a financial implication depending on the size and shape of what it looks like. Or it could be something minor, something you didn't learn about the business during due diligence. Um, when you're under LOI for a business, or if you're actively searching, your goal as a prospective business buyer should be to mitigate the risks around some of these surprises and learn as much about the business as you can. So when you think about post-close surprises, there are, several implications. The primary focus should be what does that look like? What are the implications? And is this something that's going to materially change the deal? So what we're going to walk away with is a framework to spot red flags, signals that reveal when a seller may be hiding something or maybe concealing it, and some clarity on when to renegotiate and when to walk away. Um, so why do red flags get missed? Why red flags get missed? So put yourself in the shoes of, many of you are looking for small businesses. You feel the time pressure to get a business closed, the time pressure to secure something under LOI. You may have left a traditional W-2 to go out and buy a business. Kudos to you. You have made the first step into your entrepreneurial journey, and I commend you. As a business owner, as someone who left a W-2 job to start my own business, and as well as search for businesses, it's a scary feeling. You feel the pressure and the urgency to have results. Uh, what can, as a result of this pressure, when you do find a business that checks your buy boxes, you get excited about it. Most buyers need a third party, attorneys and CPAs to do due diligence because they have a shiny object syndrome or the rosy red glasses of this business may have issues, but due to the pressure of closing, you often try to look past it and justify it when in reality, these red flags or yellow flags, as I call them, they may be material and you may need to renegotiate your deal and or walk away from what you thought was a great business because the deal and the business, once under contract, looks very different. Let me paint a picture of what that actually looks like for those who have never gone under LOI. Um, we were doing a quality of earnings for a construction company who was leveraging subcontractors. Um, the subcontractors were being negotiated and they were paying a rate that was below market, and it was due to a related party member owned the subcontracting company. Uh, in reality, those subcontractor costs following closing would be significantly higher. There was significant related party items going on between the two businesses. Um, that's something that was discovered during due diligence. Uh, when I think of other red flags that may get missed or overlooked, if you're not careful, there may be things like uh, customer concentration and significant cash cycles of the business that are not as favorable if not managed correctly. And there might be a significant owner concentration or owner dependency of the business. Every legacy business has these exceptional owners that may be the face of the business and the sales engine of the business. You need to ask yourself, what does life look like for this business once that owner seller who was a staple of the community goes away? These are some of the things we see, and these are the questions we like to answer when we're doing our QVs for you, the prospective business buyer, or the sellers looking to sell their business. Um, Deal pressure and this bias are really the worst enemies of business searchers. You can be as disciplined as you can, but once you go under due diligence, for those who have closed businesses, I see a few folks who I know who have already successfully completed sales. The pressure to close is significant, and you need to be careful and surround yourself with third-party counsel representatives to give you information that's unbiased because you are inherently biased in one way or another. So, what are some profit and loss red flags? Profit and loss, or the P&L red flags, are some of the warning signs in the income statement. What does that look like? It looks like revenue spike in the trailing 12 months. If you want to go to the next slide, it looks like owner compensation well below market, gross margin inconsistencies within industry, revenue concentration between one or two customers, and some significant uh, cost of goods sold at declining as revenue grows. Um, the P&L red flags, if you want to go to the next slide, we can keep it moving. So when you're looking at a profit and loss statement, I just shared a couple of these. You want to first obtain this profit and loss statement in the form of an Excel spreadsheet from the company's accounting system. Typically, most of these small businesses use QuickBooks Online, QuickBooks Desktop, NetSuite if it's a little bit of a larger company, or Sage if it's a manufacturing company. I know that's a popular one. But there's plenty of manufacturing companies who also use QuickBooks. Regardless of the accounting system, you want to obtain a monthly or at least annual income statement, also referred to as the profit and loss statement, and then begin scanning the document. So you'll see things like revenues, cost of goods sold, net income. Those are going to be some words you see. And then some of the red flags you want to look for are margin changes. So there's going to be your gross margin or net margin. You may notice things like the cost of goods sold or your expenses are decreasing at a faster rate as revenue grows. This is a signal of you need to learn more information. So why is that? One, the business, if revenue is growing faster than expenses, or if expenses are declining as revenue grows, the business is going to be starting to produce significant income. Um, you need to understand, why is that happening? I wouldn't, a lot of prospective buyers are only looking at, wow, the company's producing a lot more net income. This is a great looking business. But there's many reasons that you need to clarify of why this is actually occurring. Typically, if a business's margins significantly change year over year, it could be a change of the business, an accounting error, or something else. Um, Very likely, if the business is a legacy stable company, the margin should be relatively similar year over year unless there's been a significant event. Additionally, you want to understand, what are typical margins of the business and the industry it works in. So if you're pursuing a manufacturing company or a software company, it doesn't make a difference the business, but you want to understand, what are typical margins of a business with 5 million of revenue, 10 million of revenue. Like, what is typical margins of these private companies? And whether it's 10%, 8%, 15%, you want to understand, what is a normal margin I can expect? Because when you're looking at the prospective business, if it falls outside the norm, there's something you want to clarify with the accountants of the company, et cetera, to understand, what is this business doing well to be outpacing industry averages? Um, Only focusing on the fact that this business is producing a ton of incomes is dangerous, because it perceives that this is either sustainable going forward or it warrants a higher valuation. And the risk is, as a new buyer comes in, that these income levels are not sustainable. So, as an example, if the business is producing $1 million of income, and that $1 million is a percentage of total revenue that is significantly higher than what is the industry average or typical going forward. If you take on too much debt, assuming that $1 million of income is going to be produced going forward, if the business experiences a significant decline or a return back to normal, the company might not be able to support the debt you're taking on. And so whenever I look at a income statement, I immediately go to the margins of the company and assess that compared to industry averages. This is not to poke holes of the company, but it is helpful to establish a baseline, um, and understand, why is this margin higher or lower than what it typically should be for a company. Other things we see significantly are owner compensation either being well below market, not included on the profit and loss, or significantly above. Um, Typically, what we see is owner compensation being well below market rate. If you're looking to buy a business and install like a general manager, et cetera, you need to understand what that cost looks like and compare that to what market rate is and what that rate is on the business currently. Um, and lastly, red flags we see are large material journal entries booked in year end or the period end without supporting documentation. As these businesses clean up their books during a prospective sale, they may be making significant journal entries, which is not typical of the company. A lot of these small businesses are unaudited, um, and they only do annual books in line with their tax filings. So right now it's June 2026. If you are under LOI for a business, it's very likely the company has never done financial cleanup in the middle of the year. It's likely done with their tax accountants during, their filings. So they may be trying to process journal entries on a monthly basis. And there's significant risk that there's errors during this time. Um, if the company has a typical closing procedure where they close once per month, this might not be the case. But for a lot of these small businesses, um, we see errors in revenue and expense journal entries because it's just not part of their typical practice. So be on the lookout for those. So, what are some of the balance sheet red flags? Um, I always say the income statement tells the story. Every prospective buyer knows very well, but the balance sheet reveals whether it's true, whether, the balance sheet also reveals some of the skeletons in the closet. So, what are some of the red flags to look out for? Um, the place I like to start is looking at the accounts receivables. The accounts receivables is a current asset sitting on the balance sheet, and it's typically the most significant or material item on the balance sheet of a small business. Um, if you look at the accounts receivable, you want to ask yourself, what is it doing? Is the accounts receivable increasing year over year or month over month? Um, is accounts receivable staying consistent month to month? How is accounts receivable performing in line with revenue? If accounts receivable is increasing, is revenue also going up? The risk with accounts receivable is the aging amounts. Are these accounts receivable actually getting paid, or is the company simply just billing these receivables without collection? Additionally, if the company has inventory, what does inventory look like on the balance sheet? Is the inventory usable? Is it sellable? When you're looking at a balance sheet, if inventory is increasing and starting to balloon year over year, you want to unpack that inventory and assess the obsolescence and if it's sellable. Um, Other balance sheet items look like accounts payable. Um, are payables being processed on a timely basis? What does that look like as a relationship to expenses? Are there related payables and receivables on the balance sheet? Things like loans to shareholders, owners' receivables, loans to owners. You want to understand what some of those liabilities look like on the balance sheet because those should be settled before closing. All of the balance sheet red flags in small business acquisitions, if you take none of this away, a lot of areas where buyers get hurt are in the accounts receivable um, and the inventory. If you're doing a stock or an asset sale, this analysis is material. Um, Oftentimes, when folks are pursuing an asset sale, it's because they don't want to inherit liabilities of the company. You still will be inheriting the balance sheet of the company. Um, and there's still associated liabilities of that. What that looks like, particularly, it's entirely dependent on the business you're buying. But if you were to focus on the balance sheet, I would be looking at the accounts receivable and asking myself, is accounts receivable and revenue growing because the company is billing, or is the company actually collecting on those ARs that are billed? Those two things are very different. I've seen several companies that bill in excess of what they actually collect. And what it looks like is AR and revenue starts to increase rapidly, but cash coming in the door is actually not increasing. The company's not collecting. It could be due to overbilling. If it's insurance work, they may be billing in excess of the insurance policies. All of these things you need to understand before you get to the closing table. If you are still with me, the toolkit is one of our latest documents. It's a template that's 92 pages. If you want to scan the QR code that's shown on the screen, you should receive a copy of this today. It's going to have things like the financial due diligence checklist, our due diligence process, a standard management meeting questionnaire, and some of the other things you'll need to successfully handle a due diligence period if you're doing it for the first time, or you're just not very familiar with the process. If you want to scan that QR code, our latest copy was the April 2026 edition. So that should be sent over to your inbox today. So when we think about some more red flags, let's keep it moving and focus on some of the asset issues I see in practice. So if you're pursuing an asset heavy business, capital heavy business, some of the things we see in practice are, I touched on it, inventory obsolescence. So goods sitting in a warehouse that might be 10 to 15 to 20 years old that the owner says, oh, one day, we're going to sell them. Um, they're still on the balance sheet. In reality, if the business is not selling those goods in their SKU, it might just be a function of, you know, that owner paid for those items, and rightfully so. They should believe that they're going to sell them. In reality, as a new business buyer, those items should not be included as part of your purchase price at the time of closing. There's a percentage of inventory that is likely obsolete and not sellable. So that should be reduced from the inventory on the balance sheet. Other things we see as capital expenditures. So when businesses are heavy CapEx, which is the term in practice, you want to ask yourself, what are the future needs? What are the future capital expenditures of the business I'm potentially purchasing? Uh, what are the short-term needs? So what are the needs in the next 12 months? And what are the needs in the next 24, 36, or 48 months? If there are short-term capital expenditure requirements that are going to be needed to deploy on day one, those are things that might need to be negotiated before the purchase agreement is signed. Let me give you an example. If there's a significant piece of equipment that is up for replacement and it's 10, 15, maybe even $50,000, you could make a case that you as a new buyer should not have to front that bill on day one. How that looks like in practice is a negotiating point. Typically it's going to look like something like this. The current owner will say something like, "Oh, this piece of equipment is up for replacement." Um, they will make the argument that you should be responsible for it. It's definitely a push-pull, but it's important to assess the capital expenditure needs before closing and have that conversation. I've seen things like a reduction of purchase price for a pre-planned capital expenditure that you will pay for as you step in. But if you reduce the purchase price by $50,000, you can make a justification for it. Um, where buyers get hurt is the unforeseen capital expenditures. And on day 30 of the new business, you have to front that bill yourself without any recourse. Um, Other things around equipment and real estate is not as apparent. We don't see that as often. The things where buyers get hurt a lot are in inventory obsolescence and these unexpected capital expenditures that they could have identified during due diligence. So, what are some issues around the underreporting of liabilities and contingencies? Things we see in practice are some payroll tax and non-compliance. So, what does that mean in practice? So, if you're pursuing a business that has a high number of 1099 employees, those 1099 employees are not paying payroll taxes. The employers are not paying payroll taxes to 1099 employees in line with how that's structured. Where buyers get hurt is in instances where these 1099 employees are not actually being classified correctly. So if the 1099 employees are working 40-hour weeks and they live in the US, uh, the the IRS is going to make the case that they should be classified as W-2 employees, and the employer, you, as the prospective buyer, should be paying payroll taxes. Where buyers get hurt is at the change of ownership, when that's triggered, like very often payroll tax audits are conducted. If you are found liable for some of these non-compliance issues, you can be fined significant amounts of money and have to pay back taxes for some of these missing payroll taxes. You want to either assess them yourself or engage with a tax due diligence experts. We have a partner at OAG who does this. And you want to calculate what is some of the compliance liabilities that I might be on the hook for, as there's more, with the increase, the higher number of 1099 employees, the higher risk and potential liability you're on the hook for. Um, this is something that surprises many new buyers and can be something that hurts them early on in their new process. As I kind of mentioned, if you have questions, feel free to put those in the chat and I'll get to them a little bit later on in the webinar. If there are things about this you have questions on, I'm also happy to answer them. Keep that in mind as we kind of go through the remainder of the slides. So what are some of the other things? One thing we see often are earned but not paid bonuses. So if we go back, the unpaid bonuses and benefits in the bottom right. So what do I mean by that? Let's say you're stepping into the business on July 1st and bonuses are paid for employees, halfway through the year, maybe call it a mid-year bonus. If you are stepping in and these bonuses are technically earned but unpaid, the prior owner should be paying those amounts out prior to close. Um, Again, this is just another mechanism which you can protect yourself so you're not on the hook for these unexpected payments in the first 30, 60, 90, or even 12 months of your business purchase. Um, Bonuses earned but unpaid should transfer with the business, but be the responsibility of the previous owner. Similar to if you were selling your business, you are getting credit and getting paid for a multiple of earnings, but you should be settling up your uh, liabilities and debts earned but unpaid prior to closing. Other things like pending litigation and warranty reserves should also be assessed depending on the type of business. Pending litigation is something that comes up in legal due diligence and can also come up in financial. Uh, we typically will ask about litigation and open lawsuits and liabilities, but it's definitely something you want to double check. If you sell widgets and they have warranty reserves, think about a 1 or 2 year warranty. That also could be something you set aside and can calculate prior to closing and held in escrow. If questions around litigation and reserves are something you want to talk through, I would work with a financial due diligence team. If you're under LOI and this is something that's coming up, you want to make sure that your financial diligence team is setting up a reserve and calculating that amount because that's something you can layer into your purchase agreement, um, if you're at that time. So what is some of the seller behavioral signals? We touched upon this slide, so I'm going to keep it moving. What are some of the signals of potential red flags or things that could be concerns if you're under contract for a small business? If you're, when I start financial due diligence on any engagement, whether I personally am looking at a prospective company, I want to assess what is the seller's behavior like. Are they being very guarded about some of the source level access? Um, has there been key employee turnover? Has there been significant changes of general managers each year, or the last 3 or 4 years? To me, that would signal weakness in a business. Has there been, things such as we don't track that, we don't keep records of that? A healthy business a healthy business with strong margins and profitability should have very strong financials or be able to track job costs, customer retention, and margins correctly. Um, when a business that looks good on paper has poor systems, again, this begins to cause concern of the reliability of the financials we're looking at and we submitted a bid on. You, as a buyer, likely submit prospective LOIs or have secured an LOI based on a SIM or marketing materials that is largely unverified. You need to look under the hood into the accounting system of the company and verify all that information. And that starts with healthy financials. What are some other behavioral signals that could cause some red flags to stick up? Things like restating the financials mid-process. When I say mid-process, what it looks like is during due diligence, if we ask for financials from 2022 through today, if they come back to us and say some of the 22 and 23 and 24 numbers haven't been finalized, uh, again, this starts to paint a different picture into the financial accuracy of the company. If you file taxes with financials, are those also misstated? Again, it's not necessarily going to kill your deal, but it's something you want to gain clarity around certainly during due diligence and absolutely before you sign a purchase agreement. Uh, if you sign a purchase agreement for financials that are misstated, there's a risk that the business is not as profitable as you think. And this could cause a risk of default if you're levering the company up with debt. Um, Last thing is overly rehearsed answers. So when you ask questions about the company, if it feels like it's overly rehearsed or too pointed, that could also be signals that it's either not true or you want to ask more questions. If you work with a financial due diligence provider, such as OAG, we do a management meeting, typically about 2 to 3 hours, where we will ask these questions. And based on their responses, we'll have comments about what we think their answers are, if we should be double clicking on certain items. All of these things should be conducted prior to closing. So, what's a typical due diligence timeline? Um, if you are under LOI and you have about 90 days, I'd go ahead and save this to your desktop. This is a typical due diligence timeline, and this is something we do for all of our deals. You'll see that financial due diligence typically starts when the LOI is signed. That is because you want to verify and vet your financials almost on day one. Before you spend a bunch of money on legal and even conduct the bank process, you want to get that verification and confirmatory audit done by the CPA firm. Um, From there, once the QV or financial due diligence analysis comes back, you can kick off the work streams such as tax, legal, and then push towards that final closing docs, which is the purchase agreement time. So I'm always asked, you know, should I pursue with this business? Should I go forward with it? And should I walk away? Like, does this make sense? So, like, when should you walk away? Walking away is entirely dependent on the deal, and it's entirely dependent on you, the acquisition entrepreneur, or the quarterback of this deal. Um, I always shift the responsibility back to the business buyer or the acquisition entrepreneur because you are really responsible and in charge of this deal. The providers you work with, such as legal counsel and the CPA team, we can give you information, but you ultimately have to make the decision. And you need to take responsibility and accountability in whatever you pursue, because it's your personal guarantee on the line. So if the deal is struggling, you want to conduct a DSCR test, which is a debt service coverage ratio test. If you don't know what that is, I'd go ahead and look that up online, plenty of resources. If you are not passing the typical DSCR test, you might want to renegotiate the price or restructure the deal accordingly. What that looks like in practice is entirely dependent on the structure. We're not going to talk about that in this webinar, but you can leave the total purchase price the same and just restructure the cash at close or maybe the seller note. Um, these are some of the things you want to think about before you sign the purchase agreement. Number four, when to walk away. If you cannot restructure the deal to pencil and it doesn't make sense and the business can't support the loan, you need to walk away. Um, if you're unable to reach an agreement and the business cannot support the debt you're about to take on, you are taking a chance that is too great. And you need to ask yourself, do I want to close on any deal or do I want to close on the right deal? Walking away it's a choice and it's something I don't take lightly. But I've seen several people, and I know them, who have defaulted on some of these SBA loans. And if it's your first time buying a business, you really only get one shot at this. And if you screw it up and do it wrong the first time, it has multi-year consequences So it's never worth it. In 2026, we're conducting a independent sponsor survey. It's going to be um, issued sometime in early 27. If you want access to the report first, you need to participate. It only takes about 4 minutes. It's going to have respondents. Right now, we already have over 100 respondents from independent sponsors, self-funded searchers, and some private equity folks. It's going to talk about valuations. What are you actually paying from people who have actually closed deals? So it's going to be a jam-packed survey and report once we get the results back. So if you scan this QR code, you can participate and unlock access once it's issued. In closing, as we kind of wrap up, if you want access to the toolkit or the independent sponsor survey, feel free to reach out to contact@o'conneladvisorgroup.com, and we should be able to share both links following this webinar. So this is the early diligence checklist. This is definitely not a comprehensive list, but these are some of the items that I like to focus on. The first thing is requesting 3 years of tax returns and profit and loss and balance sheet statements. Why this matters, this is the foundation of your analysis. So if you're under LOI, this should have already been asked for by your provider or yourself if you're doing this, if you're conducting this yourself in your analysis. Also asking for AR schedules, customer concentration or customer revenue schedules, and then your bank statements over the last 12, 24, and 36 months. This checklist is a snapshot. In our financial due diligence checklist, it's going to have a lot of the same things like this. I think it's about 10 points, which you can find in the toolkit. So certainly scan that if you're interested. So the financial red flags, what are some of the key takeaways? Uh, the key takeaways are the red flags, they don't announce themselves. You need to identify some of these items and ask those difficult questions. So I'm asked the question a lot when I meet with prospective business buyers is I know how to read a financial statement. I come from finance, but I've never done a deal before. This is my first time doing it. I've owned a couple businesses, but I don't know this business very well. Um, if that sounds like you want to engage a financial due diligence team because when we come across some of these issues, we raise our hand and we ask those difficult questions. And it can be a very awkward conversation. Some of these sellers might not want to answer the question. They may try to explain it away in a complicated, convoluted response. You want to understand what is the actual answer to the question. Like, why has margins changed? Has there been a change of vendor? Has the expenses of the company gone up because the prices have increased due to inflation or the current economy? When you identify the red or yellow flags, you need to ask those questions with management immediately. If you don't, you risk taking on these new changes with the business on day one. Asset heavy deals need independent appraisals. You'll see I marked this twice due to the importance. If you're pursuing an asset heavy deal, you need to hire an independent appraisal to conduct a review of some of these asset items on the ground of the business. This is something that's done outside of financial due diligence. There are industry experts locally in these small businesses that will come out and do this for you. It's an out-of-pocket cost, but it can be a significant time. It can be a significant cash saver and can pay for itself 10, 15, 20 times over. What it looks like is they'll assess the equipment of the company. They'll say things like that needs to be replaced next year. You might need to spend $50,000 in the next year, etc. Um, if you're pursuing asset heavy businesses, this independent appraisal needs to be conducted before closing. Non-negotiable, no questions asked. If you skip this, be prepared to spend significant money on this replacement cost out of pocket um, following closing. And that's something that you're going to be on the hook for as the new business owner. The last 2 points is the EBITDAs and incomes of the company. That's the starting point of the business. You need to confirm that that's real and accurate. You need to conduct your stress test of the business. Um, and this is done through financial due diligence. The last point is you want to start financial due diligence and the bank underwriting process pretty close in once that LOI is signed. The reason why you start this right away is these things take time. If you have 90 days of exclusivity, financial due diligence typically takes about 30 to 45 days. Um, if you spend the first 2 or 3 weeks trying to conduct your own due diligence, or um, if you're spending time during your LOI interviewing folks, you're wasting time. And the risk is if you start these processes too late, you won't complete them in time, and you will either need to make a decision based on incomplete information, or you will try to get an extension of your LOI, and the owner will say no, and you will lose the deal. Um, what I hear in practice is folks assume that the business owner will extend it because they're too far in it, or the buyer thinks they have leverage. You could be right. I see all the time where folks go back to the owners and ask for an extension, and they're told no. And there's been many deals which have broken because the owners have lost faith in their ability to close, and they're not willing to push out another 60 or 90 days. Um, Starting these processes and taking it seriously once you have the LOI signed is how you actually close deals. Um, Last year, we were on the closing table for about 30 deals. Almost all of those deals kicked off due diligence in the first week the LOI was signed, engaged a full deal team, and did the process in line with, that infographic of the 90-day timeline, almost to a T. If you do things the right way and you are able to pull the levers appropriately when needed, this is how you actually close on these businesses. The businesses that don't make it to closing uh, look like incomplete processes that are started late by folks who may have tried to cut some corners early on.